We're going to go on the first one, that is expected and required return. I'll talk about required return a little bit deeper on the business side, but I'm going to break down the expected return for both. It starts off with the statement that I got when talking to another business owner is like, well, I can probably get 10% in my personal and maybe 20% in my business. And I said, first, let's break that down. What does that mean? In a stock and bond allocation, you're more than likely going to get closer to 7 to 9%. And it often really matters on what time in the business cycle you're investing, because there can be a big difference if you're investing in the height of the business cycle versus the bottom of the business cycle. Companies, in general, will grow about 7-8%. And that's what sets the company's intrinsic value. But the risk is that price of that company can go 20% over its intrinsic value or 20% under its intrinsic value. If you just look at the price movement of stocks over the last 100 years, it happens all the time. And let's just say you're at a 20% overvalued, and then you drop to a 20% undervalue, that's a 40% drop, which has happened before. So your $100,000 is now worth $60,000. To get this $60,000 to average 10% can take a very long time. You want to understand, even if you're investing for the long term, where am I investing? What is actually my expected rate of return? And how is that going to tie into the way I'm investing in my long-term investments? So that's how the personal side works. Now let's look at the business side. The business side is not nearly as simple as just saying, I can get 20% in my business. It's broken down by the projects and the things that you're doing to reinvest into your business, the tools, the people, all the different ways you can invest in growth in your business to improve your numbers. When analyzing a project, you start off with what's the expected return, and you then create different base cases and scenarios. So I'm putting money into this project. I expect additional growth through new clientele, more customers, whatever it might be, improving revenues, and then you create these different scenarios. In some scenarios, like, okay, if it goes well, it's gonna do this. If it goes poorly, it's gonna do this. Is the maximum loss 0? Can I lose everything by doing this particular project? You're analyzing all these scenarios to determine, is the project worthwhile? Now, the required return is super important, is because you gotta make sure that you have to get probably a much higher return than you're actually thinking. And it's gonna be based upon just what can I get in other sources of return? Well, if I'm going to rank things by risk, the more risk you take, the higher return you have to get. Starts off risk-free. Say the risk-free rate's 4%. If you can get 4% risk-free and that's what you're aiming to get, don't do anything other than risk-free. Take the risk-free 4%. And I say, I can invest in publicly traded equities. Well, that's going to be maybe 8%. Or I can invest in privately traded equities, and that might be 20%. Each one of these has different risks of liquidity and volatility, and they should be determined that I'm going to set this private equity at 20%. I should never do a project that's going to put me at a lower rate than 20%. I'm going to make a quick example, because it's not, I invest $100,000 and I'm expecting $120,000. That would be a 20% gain. So I have $100,000. And let's just say we determine there's a 40% chance of a total loss. If there's a 40% chance of a total loss, and I need to figure out what's the upside I need to get on that best case scenario, you start with the 20%. So you need to get, on average, $120,000. Well, then let's make this really simple and say 40% of the time it's going to yield 0. Meaning 60% of the time, I need to solve for X. So some simple algebra. What does X equal? Well, X equals $200,000. How do I come up with that? You take $200,000 times 60 equals 120. That's our 20%. So on the upside scenario, we need to have at least a doubling of that $100,000 for this project to make sense, because 40% of the time is going to be 0. So that's the type of math that you want to look at. It's not the upside is going to be 120 and the downside is going to be 0. You would never take that project. You need to make sure that you understand the scenarios, max upside, max downside, doesn't make sense. I have to, on average, outperform anything that's on this side. So hopefully this helps. There's a little bit of math behind it, but it's not just I can get 20% in my business. You want to be diligent about analyzing your projects and understanding what is this project going to yield and what are the risks I'm taking for it. So hopefully this helps.